And what we do know, and we like things that we do know, we like known knowns, which is that there was just a tidal wave, a 10Z scored wave, a wave that is so rare you might expect to see it once every 50 years or 100, and that was the pandemic. And it was the fact that the 10-year and the 30-year Treasury bonds, which are so important because they end up setting the price of risk throughout the economy. That they, of course, the decline owing to the pandemic allowed for households, thank goodness, to survive the economic strain by having this windfall of locking in and reducing their monthly outgoings on their mortgages. And so but typically you have, so it's it's an event cluster. And the 50 years of normalized behavior, there's no event cluster. Rates are always kind of moving over time and coalescing around, if it's going down, then it ratchets down, if you will, and stimulates activity, or it ratchets higher and it stems and stymies activity. This one just went, it was a massive structural, it was a massive overnight reset, boom, to the floor, and this gigantic amount of mortgage activity took place. And so David Levinson hypothesizes that, again, there's this knockout level that, so the mortgage rate, we're thinking 3, we're at 6, but that would be predicated on 10-year, and the 10-year went to 50 basis points, and it's presently, let's call it 400 basis points. And who knows, but if the 10-year drops below 200 basis points, and it looks as if it's got momentum, this 200 is going to go to 1.5% yield. Now, that's a pretty bleak economic environment that would have to necessitate that, or is it? We'll come back to David in a second. You're at a point where you knock in suddenly that everyone that hasn't moved house in 3, 4, 5 years gets knocked in because the mortgage rate, the benchmark mortgage rate drops, gets dragged down by the 10-year, and it comes into the vicinity of 3%, and people go, wow, I've been waiting for this opportunity, and they move house. Now, they don't have to move house. They may just refinance their mortgage. Now, how on earth are we going to get to 1.5% yield? Our job is to have. I'm a fuzzy cloud. I am trying to conceive of every possible outcome happening at every possible now moment. So yeah, I accept US 10-year at 1.5%. That requires a lot of jazz. But then David comes back and Levinson explains the hedging by commercial banks of their mortgage book. And mortgage assets, mortgage-backed securities, mortgage assets, a lot of them sit directly on the bank, and then you've got Fannie Mae and Freddie Mac, and then they might trade them. That's a $13 trillion asset. That's an enormous asset. And he explained how the banks, it's so enormous, and they have to hedge all their risks because they're quoted on Wall Street, and they grow predictably, and they don't want their earnings to be blown out by a lack of hedges. But the sizes are so monstrously great that they sometimes find themselves in a reflexive cycle where we were in a reflexive cycle where to hedge their book. So the previous cycle, the banks went from having their mortgage asset had a lot of duration, which is to say the risk of people refinancing it was very modest. That, there was again, if we think of Z-scores, there was your kind of average wave, there was your kind of wave, which is the one you get every 1 to 3 to 5 days, let's call that 1 to 3 to 5 years. And then there's the really big monster wave, and that might be the one every 50 years. We got the 50 year with the pandemic, which absolutely blew out the risk profile of this very safe asset residing on the bank's balance sheet, the mortgage. The duration collapsed, and it meant that to re-hedge, dynamically re-hedge, they were having to effectively short 10-year Treasury securities. And they were doing so at a point where the Federal Reserve had turned around and went, oh, we thought inflation was transitory. We put $6 trillion of expansion into our balance sheet. And wow, we've got domestic price inflation. It's growing at 3. Oh my God, it's expanding at 4, it's expanding at 5, expanding at 6% per annum. Peaked out at 9.3. And so the Fed went from, we've got 0 interest rates, and they raised interest rates all the way to 5.5%. That was not a good environment to be long dated treasuries. And in fact, the bankruptcy of several of those regional banks. Silicon Valley, of course, is the name most people associate with it. They went bankrupt lending to the US government. They went bankrupt on the price reset of the Treasury. Now, that's not what I'm talking about. I'm talking about that price reset on the Treasury and its impact on the mortgage book meant that with the Fed raising interest rates, with everyone crying fire, fire with regard to inflation, with every hedge fund in the world wanting to short sell treasuries, the banks, just to hedge their book, were selling treasuries. And so, wow, here we are. And over the course of the last 3 years, the price halved. We took out all the price gains of the last 30 years. It's a big deal. So back to David's point, where the poo-poo people that, hey, the 10-year US Treasury ain't going to be 1.5%. And, okay, but David's point to that is direction of travel. If we're going that way, you risk picking up this enormous reflexive machine, the US banking sector, which suddenly has to wake up again. It's like, beep, 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 alert, 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 dive, shut up, me. But the books will start to be out of kilter, out of hedge once more. And they'll be out of kilter because refinancing will suddenly spike. And the banks will suddenly start losing mortgages. They'll be resetting away from them. And at that point, the banks, they do the opposite. They effectively come in and they are buyers of 10-year treasuries in order to get their hedging back. And buyers beget buyers beget buyers beget buyers, and reflexivity, it reinforces the direction and will magnify and probably accelerate the velocity of the direction. And that's how it's conceivable that we could get to 1.5%. And so as that happens, and again, we're trying to conceive Schrodinger's cat, There's so many possibilities when you don't open the box. Because one of the possibilities, and there's a hypothesis that kind of smart, kooky people have, like David and myself, that, I mean, do you know that we have a former hedge fund manager as the US Treasury Secretary? And so Scott Besson, you gotta think he knows this stuff. And what you have is you have this so the US is sitting so pretty. Data centers, the best companies, AI, automation, has woken up. It was Samson, it had his hair cut, and it was letting China walk all over itself. It's woken up and it's reshoring, onshoring. It's probably about 25% of the way through. There are difficulties. You know, there's the vulnerability from 40 years of being asleep with rare earth refining et al. But it will work it out. And those of you who follow my work closely, the high regard that I have for this US administration and its economic policy is that it was a policy that both sides of the Electoral College rejected. There was bipartisan rejection of this policy. It was like, we got to change. We're getting run over by mercantilism. We're being impoverished and we're going to be overtaken by mercantilist states. We have to fight back. But it was never accepted because in fighting back, you run the risk of destabilizing asset markets. Because the whole thing, you know, with these awful Gini coefficients, we've got a tiny part of the population that owns everything, which is say, you know, whatever profession you have, the closer and closer it is to Wall Street, the richer you are. So the mercantilist state, the mercantilist sovereigns pumped America full of liquidity and made it a speculative society, and gave us the overvaluation of everything. Overvaluation of everything is a contentious title, but let's use that. The overvaluation of everything. And so if you're going to push the mercantilists away and say, no more, we will not be running an accommodative deficit for your surplus. We've not had the choice before, but actually we're setting in process fire breaks like tariffs to free ourselves of the tyranny of our common people. Going down that path, and the reason it was never accepted by weaker politicians was you run a risk of upsetting asset markets and asset markets falling precipitously. And, you know, like turkeys don't vote for Thanksgiving or Christmas. What this American administration seems to recognize is they've got, if you will, a parachute, which is that if you do get destabilization in asset prices, that's another factor which would cause the 10-year to slope and trend, the yield to slope and trend lower. And it begins to trigger this event risk of suddenly an enormous $13 trillion asset refinances. And the amount of locked equity, mortgage, property equity gains suddenly they get extracted, alongside the fact that the AI spending is going to be running at kind of 10% of GDP for the next 20 years. The US is not going to have a meaningful recession. And so it's unlikely it's going to have an asset price depression either. This is some of the things I thought about daydreaming today. I'm just amazed where this stuff comes from. So a long way of saying we've got $8 trillion in money market funds today. And the Fed's cutting interest rates. So it's really a nice time to revolt against the Chinese. Boom.